Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, March 20th, 2026. This is episode number 46 with the timestamp of 12 noon Eastern Standard Time. I am your host, Scott Slayton, partner and chief strategist at Capital Creek Partners. Now, your starting lineup. Number 1, our updated analysis on the Iran war. Number 2, the February Producer Price Index surprises to the upside and confirms a defined uptrend. Number 3, the Fed meeting. The Fed staying firmly on hold. So let's go right to number 1, Iran. In our opinion, in our analysis, the war is escalating, expanding, and elongating in time frame. The damage to the Qatari gas field, the world's largest gas field, the Ras Laffan, is very severe. And we're reading that it will take potentially 5 years or more to repair the damage to this field. This is very important for Europe and Asia. They are vulnerable to higher natural gas prices because they're having to import most of those natural gas liquids. Shortages could be coming for chemicals, fertilizer, other feedstocks, and natural gas itself. So our formula since the war began 3 weeks ago has been pretty simple, an Occam's razor kind of formula, that we have higher oil prices leading to higher long bond yields, leading to a stronger dollar, and leading to pressure on global equities. Damage to Middle East energy facilities could cause an energy crisis along the lines that we saw in the 1970s if this war is prolonged. Something that I think very few investors have considered is the importance of Middle East capital. The vast amounts of Middle East capital have been flowing into financial markets and into private markets to fund things like artificial intelligence. We know how important that's been to growth and innovation. And if this Middle East flow of capital is suspended or removed from the global markets for a while, that could have some major implications for all kinds of investments. And let's be honest, if energy infrastructure needs to be rebuilt, some of that capital is going to flow back. So this is just something we're thinking about on the margin. We are cautious on risk assets and expect the S&P 500 to test 6,000 in coming days and weeks. That would represent about a 15% correction from the highs of late January. And we think it's pretty simple. 20 times a cut estimate of $300 for earnings in 2026 gets you 6,000. That's very plausible to us. But we think it all hinges on how long Iran can sustain the closure of Hormuz. Do they have the missiles? Do they have the coordination? Do they have the drones to keep Hormuz closed? If they do, the war is elongated. The president can say, hey, we're done, we won, and we can leave a vacuum there, but they can still keep Hormuz closed despite what the U.S. and Israel can do. So we're going to take the over that Hormuz will be closed for the next several weeks, and that upward pressure on energy prices will remain. Higher yield, stronger dollar, weaker equities. We think that formula stays in place for the foreseeable future. Now, number 2, the February PPI surprises to the upside. Across the board, really, no matter how we looked at it, and there are 5 different ways to look at it, but PPI ex food and energy printed 3.9% year over year. This is a negative data point in the fight for lower inflation. These data do not even include the recent energy shock. which will eventually flow into food and consumer and industrial products of all kinds. We think the muscle memory from 2021, 2022, the muscle memory of raising prices by corporations is still very much there. And consumers have become inured to price increases on some level and accustomed to it. This is all about the slow unanchoring of inflationary expectations. If the war drags on and this continues to flow into prices, really a problem for the Fed. The Bloomberg Commodity Total Return Index is now up 23% year to date. So the opposite of all the other assets that have gone down in value, commodities have gone up in value and have represented a fantastic portfolio hedge. This major increase in commodities is going to put a tailwind behind future PPI prints. Remember, war is inflationary, especially when it leads to the destruction of energy infrastructure, which can take years to replace. So the PPI ex food and energy is trending higher since the end of 2023. We went back and looked at a simple chart. It peaked around 10% in 2022. It bottomed under 2% at the end of 2023, and now it's basically up to 4%. It's been trending higher for 2+ years. Now, onto the Fed. The Fed held policy rates steady at a midpoint of 3.64%. The Fed signaled patience regarding the timing of future rate cuts. They're still projecting one rate cut based on the dots they released on Wednesday, which is kind of surprising to us, but they're waiting for further clarity on the energy shock that's now ongoing. How long? That is the key. How long it lasts really matters. And that's why the U.S. and Israel need to wrap this up as quickly as possible to avoid sustained inflation, to avoid a potential recession. And the politicians know this. That's why war is hard. It's hard to time it with the political vagaries here in the United States. There are now, in our opinion, serious risks to both sides of the mandate. There are risks to inflation on the upside, and there are risks to employment, and let's face it, growth on the downside. So what do you do when the mandate has risks on both sides, and there's significant risks, serious risks? Well, they did nothing, and I think that's probably appropriate. The marketplace, financial markets and short-term money market instruments have completely priced out any cuts for 2026. The Fed thinks they're going to cut one time based on their dot plot, but the market is now pricing out all rate cuts. And in fact, this morning, Friday the 20th, there is now a 17% probability of a September rate hike, not cut, but hike. So the Fed is in a bit of a fix here. The Fed is also in a muddy transition from the leadership of Jerome Powell to Kevin Warsh. It may be a long transition due to what we would call a very unnecessary criminal probe into Powell. But Warsh probably doesn't get into the Fed chair until the fall. Tillis has said there will be no vote, and we believe him. Collins and Murkowski also don't want to vote on this. So there's more uncertainty, not just in terms of inflation and labor market and growth. There's just more uncertainty here on top of uncertainty on top of uncertainty. We expect oil prices to be higher for longer, but we also expect growth and employment to be weaker for longer. So Fed policy probably does nothing all year unless growth plunges. And if it plunges, believe me, they will cut aggressively, irrespective of what's going on in inflation. Employment and growth is more important to the Fed than inflation at this point. And politically, it's more important to the Fed as we come into the midterms. So this is yet another challenge for risk assets, that cuts are priced out. The potential of hikes is growing, and that just means less liquidity for financial markets to feed on. So do the work, endure the fog of war, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.